Boyd's with me for that market reaction. So, Ed, where do you reckon we should start today?
I reckon kick off with CSL, Ross.
CSL, we talked about them yesterday. We told you yesterday that they had announced a blood plasma product that was thought to prevent a second heart attack for recent victims, said to be $3 billion a year potentially, has been scrapped by them. Well, today CSL produced a strong set of half-year numbers. Its revenue 12% higher, $8.1 billion US dollars. Underlying profit up 11%, $2 billion US dollars. Dividend up 12 cents to $1.19 US a share. CEO Dr. Paul McKenzie reaffirmed the company's guidance to increase full-year profit between 13 and 15%. He said CSL is in a strong position to deliver annualised double-digit earnings growth over the medium term. So, Ed, how did CSL shares go?
Look, not great, Ross. Investors clearly wanted more from CSL's results. S&P Ratings said today, one issue with CSL is its large inventory of blood plasma worth about $5.6 billion US dollars. Now, the amount of products they make per litre of blood plasma is quite low. So if they can improve that, then they can expect a stronger result next half. So shares down about 3%, Ross.
OK, so let's go to one of Australia's hottest manufacturing companies of the past decade. That's Breville. You can see them here. Came off the boil a bit. Half-year profit up 6.7% to around 84 million. Revenue up 2% to around 905 million. Despite the modest growth, interim dividend, you can see, increased 1 cent to 16 cents. Its chief executive, Jim Clayton, said headwinds are expected to continue in the second half of the year, though it will launch new products and also roll out other products to regional Australia. So, Ed, Breville, it has been hot in the past. What was it like today?
It was cold today. They got smashed today. It was worst performer on the market. Revenue growth was weaker than expected because Breville stopped selling its coffee machines and kitchen appliances at discount prices. Earnings growth for this financial year is expected to be 7%, and that's a bit below analyst expectations, so its shares were off 8.5%, Ross.
8.5%. They got hit pretty hard. Let's go to Challenger. You can see here revenue up 46%, net profit up 80%. That's because of strong sales of annuities while interest rates are higher. So it's pretty good. The dividend's been increased 1 cent, 13 cents a share. It's been pushing for longer term annuity sales. And the chief executive, Nick Hamilton, said this is extending the tenor of our life book, which will support higher long-term profitability. So Challenger shares, Ed?
Challenger shares, look, they actually soared. The profit came in higher than expected. Its full-year guidance is strong. Ross mentioned annuities. Challenger today said the average tenure of its annuities have increased from 5.4 years last year to 8.9 years in this year. So its shares were up 8.4%, Ross.
OK, let's go to the next one. The US-focused building products company James Hardie. Super strong third quarter results. Earnings before interest and tax up 39%. You can see that there. Also, the revenue up 14%, 978 million US dollars. I presume, Ed, the market liked this one, right?
You think that? No. The shares have actually slumped, and that's really because the rapid increase in interest rates across Australia, Europe and the US has caused renovations market to be pretty soft, and James Hardie don't expect it to pick up again until the back half of this year, so it was down 8.5% as well.
That's a big, big hit. OK, let's go to Australia's biggest online retailer of furniture and homewares. That's Temple & Webster. Its first half profit, $4.1 million, ahead 6%. The revenue up by 23% to $253 million. The company does not pay a dividend. Temple & Webster has around 200,000 products on sale from hundreds of retailers. It uses what's called a drop ship business model, which means that other retailers use Temple & Webster's website for sales, but manage their own storage, inventory and fulfillment. The company says it's committed to achieving $1 billion a year in sales within 3 to 5 years while remaining profitable. Did it go down or up, Ed?
This one went up, OK? Now, the retailer performed strongly despite those higher interest rates. Company said millennials bought lots of furniture as they established families and upgraded their houses and apartments. So its shares up about 10% today, and they're actually up 122% in the past 12 months. But looking at the overall market, the ASX 200 opened flat this morning. Healthcare sector dropped thanks to CSL. Utilities and the banks were the top performers. Market finished the day down just 11 points. Top performers included card payments company EML, the retailer JB Hi-Fi, which jumped after yesterday's half-year profit, and the oil producer Beach Energy, that lifted after being sold off pretty sharply yesterday. A jobs platform Seek, it dropped after its revenue fell 5% and its profit dropped today by 96% in the first half. Customer volumes at Seek are now back to pre-pandemic levels, and that's due to a softening jobs market and rising unemployment rate. Seven West Media's profit, it slumped 53%. That's due to weak advertising market. And buy now, pay later company Zip, well, that was off about 6.6%. And Ross, that's a market wrap.